Hello everyone, welcome to the learning session of TradeOps. Today we will be discussing about top 5 common doubts which almost everyone comes across when they enter into the world of stock market. So let's get started. Okay, so these are the top 5 common doubts which almost everyone comes across when they step into the world of stock market. The first general doubt which everyone comes across is how do the share price move up and down? How do they actually fluctuate in the daily market? The second doubt is a Demat account compulsory and do we need a broker? The third general doubt is shall I buy a stock just for getting the benefit of dividend like one day before the execution date? And the fourth doubt is how does the compounding works for stock market? Like there is no specific way. Is there a specific way on which we can actually understand the compounding of stock market, right? And the last and the most important one, as per the current situation, is we are seeing that the economy is falling and still the market is making new highs every day. So let us understand each of these doubts in detail. Okay, so the very first common doubt is why do the share prices move up and down? Why do they fluctuate during the market? So basically the share prices depends on the supply and demand of the stock, right? So basically what happens is a buyer and a seller they come together and like the stock transaction happens. Like there's billions of shares which are being bought and sold each day, right? So uh, this fluctuation basically occurs with the supply and demand. So let's assume that there are number of buyers are more in the market, right? So basically what happens is the demand is higher, right, and the supply is less because the sellers ultimately they are less. So what would happen is these sellers they will quote a price which is higher, right? So let's assume that currently the market is running at a price of 100 or something, and now these sellers they say that I'll sell at 101 or 102. So ultimately, like since the buyers are more, so someone from these buyers they'll eventually agree that okay fine, I agree to buy at your quote price. So this transaction will occur and the price will eventually tend to rise. And the opposite of this, the next scenario is when there are number of sellers are more. So what happens is like since sellers are more, so they are willing to sell like they are selling. And we know that now what happened is now the supply is more but the demand is less, so buyers are less. So what will happen, they will quote a lower price because every buyer wishes to buy this stock at a less price, so they'll quote a price which is less. So let's assume 100 was the price which was currently trading at, and now these they started saying that I will buy at 99, or maybe there comes someone 98 one also. So since the buyers are less, someone from the seller side will eventually agree to sell at this price. So in this way the price tends to fall. So I hope that you would have understood why this fluctuation occurs and how does this price movements calculated on a daily basis. If you wish to understand the price fluctuation in detail, I have made a detailed video on the price movement. Do check the video out. You'll find the link in the description box below. Okay, so now let us move on to the next common doubt. Is a Demat account required and is a broker compulsory? Is it compulsory to have a broker to trade? So the answer is no, you don't need a Demat account. It is not compulsory that you should have a Demat account. There are instances where a Demat account is not needed to trade. But yes, a broker is mandatory to trade. You cannot trade in the exchange without a broker. So I had also explained this earlier that we need a exchange uh, to trade, and this exchange don't directly communicate with you. They need a middleman, which is this broker. This broker is the middleman in both the sides which executes the transaction. So this broker knows the person directly, so the person is connected with this broker and this broker has the right to communicate with the exchange, right? So even if you wish to buy or to sell, you directly can't go to the exchange for buying or selling. You'll have to go to the broker, and the broker will communicate and carry out your transactions in the exchange, right? So yeah, a broker is mandatory to trade a stock, whereas a demat account is not compulsory. And also there's an exception case where a broker is not needed, like this is not for trading, but you can have stocks in your account, but if you are not trading with those stocks, you are just holding them, right? So you don't need a broker for that. Okay, so let us take some instances. Like for IPO, if you'll go, you don't need a trading account for that, right? So basically, what you need for an IPO is a demat account. So generally, you would have seen that uh, whichever, even you can apply directly from Beam or somewhere for IPO. So in that scenario, they just ask you for the demat account. So you just give them the depository details, and the shares gets credited into the demat directly. So you can buy and hold those stocks, right? So as I just told that if you are not trading, you don't need a trading account. A broker is not needed. A broker's role is not mandatory in that case. So if you are not trading, just hold that stock. So for in this case of IPO, where you just bought a stock from the company directly, because you didn't went to a middle to this exchange where the stocks were being sold for the second time, third time, and so on, right? So in that cases, since you are directly buying from the company, so those stocks will directly hit your demat account, and just keep holding it. If whenever you feel that no, now I need to sell it, that time you'll need a broker. So you'll go to a broker, you'll link it with your existing demat depository, and then you can sell the stocks which are available, which you had bought from the IPO. The second is future and options. So for future and options, a trading account is required, not a demat account, because these are not considered for holdings, right? So if you are trading on currency or all these, they are the accounts generally, like if you open an account in any app or something, they'll just provide you with a trading account. Their demat account is not created, right? So for future and options or for currencies, we don't need a demat account. We just need a trading account so that we can trade on them. But for equity stocks, you need a demat account as well as a trading account, which are through a broker. Now, why is it required for equity stocks? Because now you didn't got an allotment from an IPO. You are not trading in futures and options or currencies. So you are trading in the existing companies which are listed on an exchange. So as I just told that for the exchange, you cannot go there and buy the shares directly. So you need a broker. So for buying equity stocks, you need a broker. And if you are holding that or as well, right? So apart from going to the broker, if you are even holding that, you'll need a demat account. But like if you plan that no, I'll not hold any stock. If you convince your broker that I'll never use the demat account because I am always going to do intraday trading only. So in that scenario, you don't need a demat account there also. But generally it is required, because if you hold even one stock, so that stock would hit your demat on the T+2 day, and in that way the demat account's role will come. But if you are not letting that to hit your account, like you are buying and you are squaring it off before it hits your demat account, in that scenario a demat is not even required for equity stocks. So I hope that this confusion would be clear, that why do we need a demat, when do we need a demat account, and when do we need a broker. If you wish to understand the stock market in detail, I have already made a detailed video on stock market and how this demat account works, or how these brokers and exchange communicate with each other. Everything is explained here. So if you wish, you can check out this video. You would find the link in the description box for this as well. Okay, so now let us move to the next common doubt, which is, shall I buy a stock for dividend benefit like one day before the execution or not? So generally, like you would also have ever had this thought that if there is a dividend of a particular stock and the execution date is, let's say, tomorrow. So basically what you will think is, let me buy this today so that tomorrow in the execution date even I would be eligible for this dividend. So generally, this is not advisable to buy a share just for dividend, like, or not for dividend, even for any other corporate actions, be it bonus or be it split or anything. So in that case, also, it's not advisable to buy a stock. Why? I'll tell you the reason. Just assume that the fundamentals are not strong of that stock. So basically, what would happen is, uh, because of this dividend, like just how the way you are thinking, some other investors might have also shown interest just for the reason of dividend, and they had bought the stock. So basically the price started running up, and as soon as the dividend execution date came, they all will start selling, right? So the price will eventually start falling, and if you are late, or if by chance you miss that selling time, and in that scenario what would happen is, maybe there's a possibility that the stock would never again return back to that price, or maybe it would take a much longer time. So you'll get stuck in such stocks, or you'll exit out in loss. So generally this is not advisable to go for a company only for dividend. If you have a good faith in that company, and if you feel that the stock can do better in the coming days, so just go for the fundamentals and buy a stock, and treat this basically this dividend as a cream, the extra cream which you get. So don't run for a dividend. Buy a stock for its fundamentals. If the fundamentals are strong, if they are doing good, every company which you will pick will surely give you a dividend, right? So treat this dividend as a cream of the stock which you are picking. Don't go for a stock just because of dividend. Now let us take an example and understand another reason of this, right? So one more reason is, if you are buying it one day before, like now we are directly coming to the main topic. So let us understand this from an example. Let us say that this is a closing price of today. So you also bought around this price. This is one day before execution date, right? So around this price the stock was trading, and it closed at this price. Okay. So generally what would happen, and this is the volume. So you can see that just the way you were thinking, there are several investors, or several traders to be precise, who actually thought the same way how you thought, and the volume traded that day was a very good amount, if you can see. So they all bought the stock one day before the execution date just for this dividend, right? So this was the price that day, and let's assume you bought at this price. So next day, on the execution day, this would be the opening price, and this would be subtracted from the dividend. So let's assume that the dividend was of 3.07. You can see that the dividend has already been subtracted from the current market price, right? So now what is the use? You just tell me that you bought a stock from a price, and after dividend, the dividend amount was already subtracted from your price. So you will see that negative minus mark in on your stock. So generally, if a stock is good, if the fundamentals are good, this gap could be covered, and then again it will start moving up, right? But if the fundamentals are not strong, generally they'll again start selling off this day, right? So if you can see the trades, like the volumes again went down, and they will start selling off on that day. So whoever took it for just for this, so they'll start. So let's assume you bought at this price and you sold at this price. What's the use? Because if it after this price, if it don't move upward, and instead it start moving downward, then what would happen? You'll have to exit in loss, because you had planned to buy this only for dividend, right? So this is a second reason as well, that for dividend what happens is that the price gets subtracted from your trading price, right? So the dividend amount would be subtracted, and in this scenario what would happen is, you would exit in a loss. So let's assume that this stock is moving in this price. This was the execution date. As soon as the execution, like this was the closing price one day before this price. As soon as this would happen, you'll see a fall a bit, and from here this will start trading. So if the fundamentals are good, it will again go up, right? So in this case I can say that this gap is covered, and this was a cream for me. But there could be a scenario that it never went up and it started falling from here, right, in this direction. So in this scenario, if I had went only for dividend, this would have been a good loss for investors, right? So I hope you would be clear that when should we go for a dividend stock, when should we run for a dividend stock, and when should we avoid, like, for taking entry only for dividend. Now, there is one extra doubt. I would just like to clear this. This is not mentioned in the topic. This general doubt. It's basically that most of us, I have seen like most of the members, they basically say, let's assume that a company announced a dividend of 100% of price, right? So basically, I had seen people, they have a doubt that if it's 100% and if the current price is, let's assume this one only, that it's 75 rupees. So they'll tell me, okay, so the dividend is of 75 rupees because it's written out here 100%, right? No, this is wrong. Like this won't be there. Now, this 100% of price doesn't mean the trading price, this current market price. This 100% of price is the price from the face value. Now, what is this face value? So I'll not go in detail for this face value. If you need a video, please mention in the comment box. I'll surely make a separate video for this. But for here, let's understand that this 100% of price is the 100% of face value. So for every company, there is a face value. So let's assume for this company, the face value was 3 rupees. So if it's 100% of face value, it means that the dividend would be of 3 rupees. If the face value is 10, let's assume that the face value is 10. So 100% of face value means 100% of this. So which is 10 rupees dividend generally. So generally companies mention in this manner in their sheet, and if you'll see this, you'll get confused that, oh, I'll be getting a dividend of 75 maybe, but that's not the case. Generally it's based on face value. Like if you are seeing just a statement like this, then you should understand, you should search for the face value and then calculate based on the face value. Okay, so now let us move on to the next general doubt, and this is also one of the most common doubts which almost everyone faces. Like even I came across this doubt that how does the compounding actually works in stock market? Like because I am not from a financial education background, so I don't know much about finances and how they actually works, right? And uh, what I have been feeded in my mind, like I am from an engineering background. So for me, the compound interest formula is this. This is the basic formula which we all know, right? So here, this is the amount, the final total amount after compounding, which you'll get. This is that amount. This is the initial amount which you put in the initially, right? The principal. This is the rate at which it is getting compounded, right? And then this is the time, this is the number of times this interest has been applied in that particular time, right? So this is the basic formula of compound interest which we all know, right? But for stock market this doesn't work. Like because even you know that for stock market generally what happens that this is, let's say, the price that at which you bought, and now it has started moving now, and maybe for if you are holding it for 1 year, 5 year, it will start increasing in this manner, sometimes a bit fall, then again, like in this manner. So you cannot calculate a good compounding interest. So let's assume that if you were here or you were here, so you maybe at this point the compound is a bit higher, the compounding here again it came a bit lower. So how can you justify this? So for this, what generally works here is CAGR, and this is compounded annual growth rate, right? So this works for this compound the stock market way, because we cannot use this formula out here. So generally what we need here is a end value. This is the future value which we call basically. So this value is the value at which you end your share. So maybe you would have bought at this position and you squared off this at this price. So basically this price where you squared off, or you are expecting that in the future. Now let's assume if for Nifty we are expecting that by 2030 it would be around 30,000 or somewhere. So this expectations would be the future value, the value where it would lead, and this would be the start value at which price you basically started, right? And now I am currently taking this in the days format. So for like this is 365 divided by the number of days. What you can do is like if you do wish to go for year, you can use 1 by year. So basically this will be the number of years which you wish to calculate minus 1. So this is the formula for which works for CAGR in stock market. So now let us understand the same thing from a Nifty example. So for Nifty index, we all know it started around 1996, And in this 25 years journey of Nifty index, we have seen that this is a compound growth rate of 11%. Now, this is for 25 years, right? For this complete period, because as I told you here, this period system works for compounding, right? So maybe here it would have been right 7% for this 1 year. Maybe for this 1 year it would have been like 13%, 14%. Here this maybe it would have been right around maybe 20% or something. So it doesn't matter for this periods in the overall run from the here to here. The overall run, the compound which comes for annually is 11%. So for each year it was approximately 11%. For 1 year maybe it would have been different. I'm not saying that for it will be 11% for each year out here. It will be different, but over the span of this 25 years it's 11%. So I hope that you'd have understood the CAGR concept which works for stock market. It is not the general compound interest which we work. So, and normally I have seen that all who are not from this financial education background, they generally feel they have this doubt that does this work, and it takes a good amount of time to understand in the stock market that how this has taken. So I hope that you will not have to waste a good amount of time to understand this, and you will understand that for stock market the compounding is basically on the basis of CAGR. Okay, so let us move to our last doubt from the list. And this is the most common doubt which almost everyone has in the current situation. So we are seeing that the current market is making new highs every day, and even we saw in the last previous year that after the March fall, the stock market recovered in a very good speed, whereas in on the economy is falling, and it is taking a good struggle to recover, and it is at a very small slow pace which is running currently. So let us understand why is this difference created between the stock market and the economy. So now, to understand this situation, let us take an example of a person, and this person has a dog with him. So generally, daily, this person and his pet dog, they go to a park for work. So today also they just plan to go to this work. So basically what happens, this person has a path defined. He knows that he'll go to the park, he'll walk around, then he'll sit on the chair, then after some time he'll return back. He has his path defined, right? And this dog also generally does this. But let's assume one day this chain broke, this dog chain broke or something, right? And now this dog is free, let's assume. So in this scenario what would happen is, now this dog can roam anywhere, right? The path for this dog is not the same as that of this person. So basically this dog can go, like it will start roaming the park. It will go anywhere it wish, even if the person tries to catch the dog. But uh, maybe he was not able to catch him up, he ran away, and he is roaming around, he'll jump, he'll like go anywhere he wishes to, right? But at the end of the day, like just assume that this person tried to catch this dog for several hours, but he was not able to catch this dog after the chain broke. And eventually went up, he was tired, so he went to a chair and he just sat there, right? So this dog, after like exploring everything in the park, and like after giving a good amount of like after troubling this owner for a good amount of time, it will return back to this owner only. We all know that these pets, they'll roam around and they return back to the owner. So eventually this dog returned, right? So it was not necessary that this person has to follow this whole way the way this dog went, right? He could have just went and sat there. Even if you do this, if you have a pet, you know that even if you set this dog goes, he roams around everywhere, and then he ultimately returns back to the owner. So now in this example, this person is the economy of a country, and this dog is basically the stock market. So just understand that for the economy, there are several factors on which the economy basically runs. Is the technology development, capital, be it law of the government, or basically the infrastructure development or unemployment rate. There are several factors on which the economy basically works. But are these factors the same for the stock market? Do you think that all these factors also gives an impact on stock market? Yes, there is a small impact, but is it necessary for the stock market to also go according to these? No. For stock market, the only thing which actually matters is the company performance. If the company is showing good results, if there is a grow in the company, and generally for most of the companies, if there is a growth, the stock market shows a good run basically, right? So for stock market, the only thing which matters is the company's performance. Whereas for the economy, the company's performance is only a part of that portion, but it is not the 100% of the economy, right? So, in this current situation, why is this market running and why is this economy taking a smaller pace? So, to understand this, eventually in the longer run, we know that in the duration of 5 years, 15 years, 10 years, or maybe a bigger duration, economy and stock market will eventually lead to this similar pace. So they'll come back to the same level. But now in this current situation, stock market is running a bit higher. It always creating a new high, and economy is generally at a very slow speed, right? So we know in the longer run they'll eventually come here. But now let us understand for this current situation why it is happening in the current situation. So for stock market, the best thing is the government is also supporting the companies. Like there are packages, there are plans which are coming for policies which are coming for the companies which are helping in the basic growth of the company, right? Investors are also foreign investors are also showing a good interest in the current Indian economy, the current growth of the companies in India. So these are some reasons why the stock market is basically running. So one of the other reasons apart from this is also, just take again a small example. Just think that you go to a bank, right? So basically what do? You go to a bank, you deposit there. So let's assume you are before, like our fathers, or what they used to do, they used to deposit in the bank in form of FDs or something. Now this bank, what it used to do was, it used to give this money which it has collected from us. This money was given to companies, right? So these companies take it in the form of loan, and they used to grow their business, right? And even if you are invested through stock market, if you are investing in this, so eventually you are also investing in the growth of the company. So company takes this those money, and it is basically growing their business, right? So if the company shows good performance in the quarterly results, final results, and in the long run, if the company is showing, it will return this money back to the bank also, and eventually the price will also indicate a good growth, right? Here in the stock market as well. So even you are getting rewarded, right? So this company growth is what what which matters ultimately for stock market. But don't you think so that this company also impacts the economy? So if this country is growing, if eventually the economy is also growing, right? So the money flow which is increasing, if there is a good money flow, which we call that, which is the job of these financial institutions. So um, if there is a good money flow in the market, right? Every people are like the, be it in form of loans, investments, or anyway. So if there is a good money flow in throughout the market, generally we say that there would be a faster recovery, or that's the reason why, like we have seen that in America or other countries, the stock market on the more people are interested. In India, it's limited to some investors. Like even nowadays also the mindset of people for stock market is not that much good. So maybe in the coming days it could be a better way, but for this situation it's not much better for this. So if this flow is going on, this company will also eventually show a result for a growth in economy. But this is not the only way. But for stock market, this is satisfactory. So if the company is doing good, for stock market it is happy, until and unless it's a bubble. So the results are not showing that impact, the fundamentals are not good, everything, nothing is good, it's just a bubble which is being created. So in that scenario, it could be that stock market would eventually crash in the coming days. But now in this 1 year scenario, we have seen that the companies are showing good results, their results are also improving, and because of all these reasons we can conclude that yeah, this pace which is happening is actually good, beneficial for, like it is based on the company's quarterly results or annual results, like they have also improved their performance. So this market is mostly going towards the right direction, right? So yeah, I can say that according to my opinion, stock market is going up, and in the coming range of period, maybe 15 years or 20 years, again we will see the economy and the stock market together. Maybe in the 5 years as well. We cannot say that. And maybe in the 5 years only, or in 1 year also, the economy can show a good recovery and it can go to the level back. But in the longer run, generally run on the same way. Now, currently, for this situation, the stock market is running and the economy is a bit slow down. But maybe in the coming days, it will also recover. So now the reason is, why did, if this was the scenario, then why did it fall down in the lockdown period? So lockdown is the only fear for the market. You should understand this. So if there is a lockdown, the companies would be shut down. They cannot operate, and this is the only reason why in stock market good correction which was seen right now. So this correction also because of this lockdown and all the confusion. Like market doesn't like confusion. Make it crystal clear. Everything, if it's clear, they know that either there is a lockdown or there will be opening. That's very good. If you are creating a confusion, that's not good for market, right? So these are some reasons why in lockdown, because if there is a lockdown like which happened like last year also, this year also, that was a that quarter got affected because of non-operations of the company. So that was a small reason why market corrects itself as well. But that's not the case that it will not recover from that, basically from that correction. Ultimately, like we have seen that again the stock market has taken a turn and it's again moving towards new highs, right? So I hope that you'd be clear with this economy and stock market situation, that why the stock market is even moving further and making new highs even when the economy is falling. Apart from this, I would also like to add that generally it has been seen that if there is a economic fall, or if there is a such pandemic which occurs or something, this is based on the history which we have seen. Generally, after these events, when these ends, generally there is a huge growth which has been seen, like based on the past data, we have seen that whenever such pandemics or such events occur, after that the economy starts recovering at a very good speed. So maybe we can expect the same this time as well, that in the coming few years the economy will actually grow further in a very good speed, and not only recover, it would even grow further in a very good speed. So I hope that you would be clear with this market movements. And if you still have any doubt, you can please feel free to ask in the comment section. So that's it for the day. We'll be meeting in our next video. Till then, have a nice day. Thank you.